alternate investments. Alternate investments, it could be in stocks also, or it could be in other asset classes. Now the reason is the continued fall in the equity markets despite some correction in the last couple of days. So first of all, we have to understand whether the equity markets is turning around or further fall is likely, and what to do with present investment. Third thing is whether we should invest more. If at all we have to invest more, then which area we should invest. So these are the things which we are going to look at it now. We have seen that in the last couple of days, the developments have been in line with what we have been expecting. That is the increase in interest rate in US. Indian interest rates have also gone up. As interest rates go up and liquidity is withdrawn, then generally it is not favorable for the equity markets, because the equity markets is supported by two important factors. One is the valuation, and second is the liquidity. Now this is now getting into trouble because increase in interest rates and withdrawal of liquidity. Valuation, they say we are okay with a long-term average because right now we are trading somewhere between 19 to 20 PE, and generally this is an average PE. Markets get into this mode and then it tries to bounce back, but the worst can be up to even 15 PE. That is, in case if there is a big problem, in that case the markets can slip down even up to 15 PE, which means another 20% fall. So we are not talking about that, but I am saying that these levels in a panic situation has come through. Now the US markets generally now are in a declining mode, and Indian markets are very strongly correlated with the US markets, and global markets also tend to follow that. With inflation still running high and interest rates will continue to increase at least for a couple of months, and we will not get any supportive messages as far as the interest rate decline is concerned, at least for a couple of more months. So the equity markets turnaround will come once we start seeing the peak in inflation. Some positive aspects have started to emerge. One is the decline in crude. Decline in crude, this has started now because demand is likely to be affected by increase in interest rates, and also there are talks about giving some tax holiday in US for oil companies in order to boost production. So this has started to happen. Then metal prices have started to fall. Metal prices generally, you look at the steel, aluminium, copper. So metals prices have started to fall. So these are positive aspects now, but to translate that into the inflation figure, in order to see that, we may take a couple of more data prints. So it could be around September, October before we come to know that probably the inflation has peaked. So that is the place where probably a turnaround in the market can take place. So till that time there can be a couple of more months of fall, and once you start the inflation peaking, that's the time when we should now look towards equity market investment, because going forward after that the interest rate increase will stop. Liquidity may not be pumped in, but the tightening of liquidity by the time would have happened already, and interest rates will just almost get to a peak situation by October, between October and December. So after that negativism may go, but the equity markets can still form some sort of a basing pattern before it starts to rise. So that is a possibility. So to what extent it will go down before it forms some sort of a base formation to go up, so which we can wait for, because if this is a clear case of economic softness that is likely to come with some higher inflation, then definitely equity markets, even after some fall, can struggle to rise for some time before the full-fledged rise takes place. So there could be some months of consolidation before the equity market starts galloping up. So it could be a couple of months, but markets being market, we cannot predict, but this is our estimation. So we should not get overly caught in some sort of a forecast model and then become prisoner of our thought process. So estimation at the same time is also very important. So going by that, all these things, it's an estimation that probably the equity markets, general correction in whenever it happens in a bad situation also, there is always a correction, which could be in the normal correction in the recent periods, is generally in the range of something like, first is around 5 to 6%, then it becomes something like approximately a 9% move. So if we look at that, this 9%, 8 to 9% happens in US markets, then we follow something like a 6.5% approximately in the Nifty index. Now there seems to be some correction now in US S&P, which means that that 15,175 which we formed, normally we see up to 1,000 points rally, right? So we'll just show in the chart that any correction, right, in the present circumstances comes closer to around 1,000 points now. So 1,000 points means that probably a 16,175 area is possible before we start to see the decline. Okay, so this is possible. I'm not saying this has to happen, but for which there are multiple resistances to be cleared, which itself is for 15,735, then 15,850, 860 levels. So these are all areas to be cleared before it even goes to that. But in a bigger correction, a 1,000 points correction keeps happening. Okay, so we will first look at the chart, then we will come to alternate investments, both in terms of stocks as well as commodities. Now, if you see in this case also, see, this is a 1,000 points rally, 15,739 to 16,793. So 1,000 point rally. And if you see here also the fall first, when it went up 18,114. So once it started to fall below 17,100 levels, then in that case, no, it just started to fall, and after that it has not risen there. And here also, if you see, let us say this is a 18,350 and 16,800 it came. So from 16,800 it just moved to 17,800. So 1,000 points of correction. So whenever we see, we see something like a 1,000 points correction that takes place. And here also, if you see 18,600, then 17,600 you can see. So after which the fall started to be a little steep, and then after that it fell up to 16,410, then 17,410, above which probably it started to become a little the rally mode started. So right now we can figure out something like a 16,160, 170 levels, and above that probably we will be, that is this particular place. I don't think this gap is going to be filled that easily. So this is 15,000. So this is 16,172. So this gap, this is the low, 16,172. Probably it can stretch itself a little bit up to that, but I doubt very much whether it is going to go much above that. So and also let's look at the Fibonacci from this particular level. So now we have the 15,792 resistance that is possible, then 15,981, and then 16,000. So I think probably there is a chance that it can move to one of these two Fibonacci levels before it starts to fall. So a bigger correction can take it right up to 16,169 or 16,170, and after which there can be a fall. So suppose if it's going to fall, to how much it can fall. Now let's look at the big chart, monthly chart, and we'll draw the Fibonacci from this place. Okay, so the 38.2% retracement of the entire pandemic low to the last 8-9 months, the recent peak of 18,600 gets us closer to the 14,358 mark. 14,358 mark is what we are getting there, right? So possibility of a rally up to 16,100 and then a fall up to 14,350 is first the likely estimation that we can look at for the Nifty. Only if it starts either breaking the 16,150 or so, then probably we may get another 1,000 points of rally, which is possible before it starts to come down. So that means it could be another 2,000 from the bottom. The rally could even stretch itself a little bit up to maybe 17,400, 17,500 before it starts to fall. So that's a huge correction that can come. Nothing can be ruled out in markets, but right now speaking, I think we should be looking first at the 16,100, 150, a break of which can take it right up to even 17,400, 500 levels before it starts to fall. Now the 14,300 levels is where probably the bigger investment, that is, if you're looking at the investment, then the bigger investment should come at 14,350. There are multiple talks being talked about even 13,050, 13,100 levels and all. But assuming that you are investing at 14,358, then you do some SIP, okay, right up to 13,050, you will average it out. So what you should strategize your planning as far as investment is concerned, that you will be putting a slightly bigger investment to closer to 14,350, and if it starts to fall, then you will have some investment still at some intermediate levels right up to 13,050, and at 13,050 you will still do some amount of investment higher than the total SIP that you have put at that point of time. So this is how your planning should be, because that will investment at these two levels which I am talking about definitely will turn out to be positive over a period of time. So that is as far as the first area of where we should invest, that is at what level we should invest, is you should keep this particular thing in mind. So this is a clear call for those who are looking at the investment. Those who are looking for big scale trading, now we should look at the this is the as I told you, this is a 1,000 points rally that is possible. So 1,000 points means you will have first of all it could be split into 3-4 levels. Probably the first resistance 14,170 means, then some 230, 240 points. 14,400 approximately can be one support, which is what is coming and taking and then going up. 15,350, 370, 80 levels where it is coming and taking support. Then of course then we will have the 50% retestment of his 500 points, which is 15,670 or so. That is also where the market is getting resisted right now. Then probably we will see something much higher, 15,900, 950, going right up to 16,150. So this 1,000 points area you can easily split it up, okay, split it up and work on this. So right now we are looking at the area that is now the present situation looks as if a little more upward movement is possible. Little more upward movement is possible because two things. One is that we have got a slightly higher low. See, this is the low, and this is the low right now because it was able to break yesterday's high. So that means we are looking at some sort of a support at 15,367. 15,367 is a place we are looking at some sort of an important support right now, and probably that could carry itself a little higher from now onwards. So probably heading towards this particular level which I told you, that is 15,850, 863 levels, and then probably getting itself right up to 16,100 levels also. That is possible. This is a possibility. So we will not short immediately. That's the first call. Let's wait for some higher level before you go for a short. So those strategies we will look at it tomorrow. That is what is the strategy that we should do as far as Nifty and Bank Nifty is concerned. So right now we can say the short term movement is a possible short covering late rally which could take right up to 16,150, 170. So today's price action suggests that probably we have a bottom at 16,370 levels because of a higher bottoms that has got formed. So till such time that 15,350, 360 is not broken, we should be looking towards sort of a buy on dips, keeping 15,350, 360 levels as a stop loss. And we should strategize our big investments, as I told you, wait patiently for a bigger drop towards 14,300, at which point we can take a call. Now, having said that, is there what is it that we should do as far as individual stocks is concerned? So how should we first frame up our mind in this? Now, first of all, some sort of reading of the situation, that is getting data, getting information, okay, is very, very important. So from the overall, you don't need to be exactly reading the balance sheets and all, but you need to get a macro picture. That is macro picture in the sense that which sector is likely to do well, okay, and both in terms of the charts as well as fundamental factors. Now, you know that the increase in, from the basic thing that we can read is the increase in interest rates normally does not support a commodity market, particularly the interest rate increase, because the aim of the interest rate increase is to dampen the prices. So that is the reason why we have seen that the fall in commodity related stocks like Tata Steel, they have been falling more than the fall in Nifty. That is because they expect these prices to correct as the interest rate increases happen. The demand softens, hopefully not a recession, but demand softens because economic growth softens, which is not good for the commodities cycle. So that means which sector we should not be in is commodities, straight commodities, right? So that means better to avoid or be bearish in sectors like Tata Steel, okay, steel, copper, okay. So it could be Tata Steel, it could be JSW. All these stocks are unlikely to do well. When this doesn't do well, what is likely to do well? Generally, auto is likely to do well because the input prices go down. And if they don't decrease the price, because they could not increase the price earlier too much because of demand reasons and as well as because of competitive reasons, now their expected profitability can go up, which means it is positive for auto sector. So in this particular cycle, we should have switched by selling commodities and getting into end product use. So auto is one sector which can do well. So, and in that leading sectors are stocks like Maruti, Tata Motors, okay. So these are stocks where probably we should be looking at it. Another thing is that we will look at the charts also in order to corroborate what we are saying right now. As we talked about commodity cycle, which will not do well when the economy it's a soft patch. Banks also generally will not do that well because probable softness in growth means probably it can hurt consumer demand, which probably can translate into lower profitability for banks, because their ability to sell on loans and other things will be less, because the housing loans can get affected because of the increase in rates, and also because the economy comes to a little softer patch, then the credit growth, other things can get affected, which is not the case till now, but it can get affected. So generally better to avoid banks. So commodities, banks are to be avoided. Now, as I told you, the auto is preferred. Like that, there are certain sectors which will use commodities where which can boost their profit in case if the commodity prices come down. And one such stock is Asian Paints. So because the declining crude price can translate into a better profitability as far as Asian Paints is concerned. So autos, stock like Asian Paints. Then consumer stocks, generally we have to see how it, but you can look at it like now consumer, we're talking about like HUL. They have not done badly in this doing after this pandemic, but they have not done extremely well. But in this, it becomes a defensive sector because the moment other stocks go down, then there is a general preference to invest. Okay, so the funds which are there have to slightly increase their allocation to certain other stock sectors, right? Because they cannot be completely in the cash. So which are the sectors that will get preferred because of these reasons? Could be like, or by default at least, could be consumer companies like HUL, Dabur. So these companies can probably look towards doing well. Okay. Then we have to see how the news related to coal. Now, if we get a feeling that the coal prices also will dampen down, then probably the cement stocks profitability can increase. But at the same time, cement stocks can also get buffeted by a softness in housing sector because of the increase in interest. So it has conflicting reasons. So we have to be quite careful about that. Now, the other important sectors that we are talking about is IT. Now, IT generally should have done decently well because one is it's a defensive sector because when others are not doing well, IT generally should do well, particularly when the rupee is declining, and also with a clean balance sheet, with cash in the balance sheet, it should normally do well. But what happens is that IT companies are very strongly correlated to Nasdaq stocks, and the Nasdaq stocks generally in a higher interest rate environment, because because of the deleveraging that is taking place, unwinding of transactions where they were heavily invested in the Nasdaq type of stocks. The fall in those stocks are now much higher. Okay, much higher, and some of those are also consumer related companies, like for example Apple and Tesla. So these are all consumer related companies. To some extent the economic issues can also hurt them, but not much because the demand is still inelastic for most of them. So generally this is a sector which can revive itself quite fast, and chances that money can come back there. So one can look at on some important dips at some strategic level, as we were discussing about certain stocks like TCS last time. So this is something which probably you can look at. Okay, so you can look at IT, you can look at auto, you can look at some consumer related companies. You can better avoid banks, commodities. So now you have got a broad idea of what to do and what not to do. And telcos, now the 5G spectrum is coming, so allocation. So suddenly we see sometimes Bharti Airtel just zooming up, and again some conflicting things come back. So it's a slightly bit of a risky scenario. But be careful about telco investment, because you've got only two major players. One is the Bharti Airtel and Reliance. So Reliance is highly diversified, so it's a very different league. Now other things is the general investment related infrastructure related companies like L&T, in which there is not much for a call to be taken, because there can be a reason for, if the growth slows down, then probably infrastructure companies can also get a little bit affected, but it will also depend on what type of projects they get. So it's a very split opinion on stocks like that. So we will have something which is very clear, and let us look at some of these companies through the prism of charts. Okay, so how they are doing right now. Now, before then we will go to the alternate asset class itself. Now we are talking about equity. Then let us see whether the alternate asset class could be only in gold immediately, right? So we will look at that also. So we had already talked about the Nifty. Now we will look at let us say we talked about which sector to be in. So Maruti, we will look at Maruti. So today it has zoomed. In fact, if you see in the last couple of months, when look at the monthly chart, we have seen Nifty right now where it was in a falling situation. You can see Maruti in a rising situation. So that very clearly corroborates what we are saying. And today, in a single day, we saw Maruti zooming. Maruti is zooming to 8,274 from 7,800, 471 rupees, almost 5 to 6% rally in a single day as far as Maruti is concerned. So now it has broken this particular high also, which means very clearly right now Maruti is in a bullish situation. So where to buy all those things we can. So only thing is this sector and this particular stock. So just look at this on dips. So that is a sector where probably you can on stock that you can be in. Tata Motors. See, Tata Motors also doing well. In fact, it has done well in the last couple of months, though it has also fallen. It is now it is a better bet as far as the rally is concerned. So I think probably Tata Motors has found its bottom at 360. That's how we guess. So Tata Motors is one stock that you can look at it for reasons which we said, and also besides the fall in commodity prices, Tata Motors is now positioning itself as a leading electric vehicle manufacturer. So that also will be very helpful, because according to the Transport Minister, by 2025 India will be a very leading producer of electric vehicles, which means Tata Motors will play a very important part in that. So Tata Motors is what we have looked at it. Now, which sector to avoid, which we talked about? Tata Steel. See the fall. Now 1,500, 841. So almost 40% fall. No, 40% fall has come in Tata Steel, and it is still falling. So if you go by the P ratio and all, Tata Steel is quite attractive. But I don't think so you should go with the fundamentals of looking at the P ratios and all. But that will become play important part once the interest rate peaks. That time probably Tata Steel could be in, because during a period of last 2020 pandemic time, after that when the interest rate started to go down, we have seen the zoom from 200 to 1,500. That was one of the best performing stock, right? So at that point of time, nothing could match the performance of Tata Steel. So such a situation can come maybe after 6 months or 1 year. So wait patiently as far as commodity stock is concerned, and Tata Steel is one example of this. Now we will look at HUL and Tata Consumer, because we talked about consumer products. Relatively doing much better, right? So if you see Tata Consumer also, generally it is holding. This is a monthly chart and weekly chart. We'll look at it. So this seems to be fairly, though it has fallen along with the Nifty, but recent period it is just holding above the last important lows. Like Nifty formed one low below the previous low, but it does not happen as far as Tata Consumer is concerned. So showing a relatively higher degree of resilience. So Tata Consumer Products is another important company where probably you can look at it. Then we will look at HUL, Hindustan Unilever. See, Hindustan Unilever this week has done extremely well. So this 2,100 can be a very important support level, and today it has even done well. I think let's say I think it has done quite very well, right? Hindustan Lever has done quite well, and this is not a company which is going to give great return, but probably you will not be in for such a fall like what probably is likely to happen in the case of other stocks. So to that extent, Hindustan Lever, Tata Consumer Products, which we have shown, Tata Motors, Maruti. So these are all stocks, because we are talking about alternate investments. it's not necessary that you should be in the fear of panic in all stocks. So these are things which are likely to do well. And let's look at TCS now. We are talking about IT stocks. Let's look at the Tata Consultancy Services. Of course, Tata Consultancy has done well, relatively speaking. So it is zooming when compared to Nifty. You see the rally that has taken place. Now it has come from 3,000 level to 3,300 level. So 10% rally has already taken place. Nifty has not rallied much from 15,175 to 15,400. It's hardly 2-3%. But whereas you see Tata Motors has rallied by 10%. So buying Tata Motors and all at strategically low level is very important. Now, if you look at this one, so in the case of Tata Motors, now let's look at the bigger trend line point, a weekly trend line, right? So this is going to be a very important line, and if it's going to further break this low, which is 33.50. So any break above the 33.50, I think then in that case, we can say Tata Motors has even formed its bottom, a bottom. So Tata Motors, I feel, looks to have, because it has already come down 25% from the peak, from 4,000 to 3,000. So that's a 25% fall in a big stock like TCS. I think we should accept that probably the correction in TCS seems to be even over, but we will wait and see. But this is one stock which probably at every low level one can look at a buy. Okay. So we have talked about TCS, we have talked about Bharati, Tata Consumer Products, Hindustan Unilever. All these are good investable stocks, and one stock which has to be avoided is commodity stock led by Tata Steel. So you can make a portfolio of a bull bear situation, and look at these type of stocks for your portfolio, and those type of stocks to be eliminated from your portfolio, and probably even to take a reverse position there. Now let's look at the bank side. So we will look at both the public sector side and private sector. Private sector, we look at ICICI compared to even HDFC Bank. Not something where it's a very lackluster movement. So nothing, as I told you, something which is not coming to your mind, like the way the TCS and other stocks which you just talked about. So it's not coming through like that. So you can better put it on a wait and watch mode. Now Asian Paints. Again, Asian Paints, the rally, today's rally probably confirms that probably the stock is trying to bottom out, because you can see the stock consolidating in between these two levels, that is 25,090, 2600. So 2600 seems to be holding on for this, and this has also fallen by 3600 to 2600, which is around 1000 points, which is approximately the same 25%. So I think this stock has already fallen by 25% from its peak, which means it's definitely a stock which can be looked towards buying, because even in the past circumstances, let's look at and this stock can get benefited by decline in crude prices. This stock can get benefited by decline in crude prices. So except for the pre-pandemic levels, generally during this situation, from 1227 it declined to 851. So that's the time where it declined by 30% or so. So now it has already happened 25%. So that means reasonably a very safe stock to look towards investment, and couple of months have already taken place as far as the fall is concerned. So looks to be quite on the interesting side. So probably if the first resistance can come closer to the where it is right now, there is around the 2850, 2860 levels. So 2850, 2860 levels, if it's break, then it can go up to 2980, and any further break about 2980 probably could mean that we are looking at a reversal taking back about 3600. So Asian Paints, Tata Consumer Products, Maruti, TCS, all these stocks should be considered as far as investment is concerned. Tata Motors, all these stocks. And let's look at some bellwether stock generally, which is doing Reliance L&T, before we move to the alternate asset class. Reliance Industries. Now, Reliance probably no, it has already hit a very important high of 2800. So I think we need to wait and see how much it's able to go down before we look towards buying. So I think it is better to hold as far as Reliance is concerned. After the announcement of the result for this particular quarter, the June quarter result, if it comes out, probably we have to see how it behaves. But most or less, I think a lot of good things have been factored, and crude prices are going down. Not necessarily that should be negative for Reliance, because it is all more on the refining margin, which is still doing very well. But somehow we get an impression from the chart that probably, since it has not fallen much compared to other stocks, probably we need to be careful about it, because if the fall takes place, then in that case we would have ended up buying at some higher level. So let us wait as far as Reliance is concerned. Look at L&T and then look at SBI before we go to gold. So as we said that the general situation is not good as far as demand is concerned, because of the higher interest rate cost, and economy probably could feel the effect of higher interest rates, because L&T has declined a little significantly. So I think we may even see a fall right up to 1300 levels also possible. So let's wait for the 1300 levels before we make a decision as far as L&T is concerned. We look at SBI. State Bank reasonably holding because of its attractiveness as far as the investment is concerned, not going down much, coming down from 550 right up to 425 levels. There's a lot of talk about higher and higher prices as far as SBI is concerned. Over a period of time, it is even expected to reach 750. So a stock which is to be watched, even when compared to private sector banks, SBI is to be watched because of its potential to gather pace. So right now the 425 has held considerably. So we could probably look towards SBI as a possibility for buying, because see in the market that went down from 550, it has come down to 450 levels, 440, 450 levels. So it's not that it's underperforming Nifty. So maybe it has moved along with Nifty. So chances that it can also, probably because of the Nifty's fall that is likely to take place, SBI may not gather pace fast. But when the markets come down to 14,300 or so, that time look at SBI. Okay. So these are the stocks that we have considered which are bright for the time being, and those are stocks which are to be considered on dips. That's what we have classified right now for alternate investments. And also we have said that when you look at investment, look at Nifty at around 14,300 for bigger investment, assuming it is going to even go below that for some reason or the other, which may or may not happen. That look at SIP down up to any level, it will quite be positive over a period of time. But considering that liquidity being withdrawn, interest rate going up, chances that there could be a good amount of basement formation before it takes off. So right now the rally will still not be holding. Whatever happens, there will be a fall. It looks like that. Now we will look at gold. So why gold? Now, is there a compelling reason to buy gold as an alternate class? Now, commodities are generally falling, right? So what are the circumstances in which the gold will do well? Generally, we should see lower US interest rates. That's the time gold generally does well. Of course, previously they used to say during period of inflation, gold will do well. During period of uncertainty, gold will do well. There are two factors. One is the rupee gold and another is the dollar gold. First of all, the dollar gold, right now could be range bound because we don't expect the interest rates are going up, and the reason why gold is still holding up at around 1830-35 levels is because the stock markets are falling. So people are the funds may have shifted a little bit from the stocks and might have invested more in gold. That could be the one important reason, because right now the worldwide the companies are long on energy, and that is going to get unwound very shortly. So energy is one sector where probably during this period of fall, which has happened the last couple of months, there's one sector which held up well is energy. But right now, I think energy should not be there. I think we should try to get out of energy, because there'll be reason to bring down the energy prices, because the higher inflation definitely requires taming, which means energy prices have to go down. So gold is something where probably churning off of from energy stocks as well as from other stocks can find its investment through to gold. But at the same time, the interest rate scenario in US does not favor gold. So there are alternate factors, counterbalancing factors as far as gold is concerned, which means that the gold can have a very subdued trading, for a couple of more months, but it can outperform the equity markets in a shorter period of time, because the pace of decline in gold is going to be quite limited, which means that you want to play it a little bit safe. At this moment, gold can still be considered, not from the point of view of getting a higher return, but at least defending yourself, at the same time not losing money, getting something like an FD interest rate, those things. That is not a spectacular return, but instead of losing money for the time being in some of these areas, better than look at gold. Okay, to that extent, gold can play a safety net right now. If you see the gold price, generally it's still a range bound price as far as the international price is concerned. You look at gold. So this is now holding on to this level, which is 1805, and right now it's going at 1842 levels. So right now gold is it went up right up to 2050, then it has fallen there. So any fall that can take place probably can get limited itself to the 1678, or it may not go down to that extent, 1755. So international gold price, if it comes close to the 1755 levels, which means another approximately 80-90 points of fall, with another 5% or so if it comes down, and definitely it's good for investment, because from there the chances that it can again go back by another 6-7% during this year, which can give a return which is higher than probably the equity markets at this point of time. So from that angle, gold can be considered on dips, okay, as an alternate investment class. It can be considered. You can also put it in SIP, but it's going to be quite a lackluster. You cannot expect a very spectacular return in gold also, but nevertheless the fall will be will not be much. So to that extent, an alternate investment class, gold, fits in at present. Then there are the normal returns that you get. That is, you normally invest your money in FD, gold, equity markets, right? Apart from the real estate, all those things. But most of the money is parked in FD, gold, or FD, mainly for getting returns, right? So this is all still not getting much. Maybe from bank to bank it varies from 5.5 to 6.5% still. So not much of a return still. After tax it's still lower. So you can look at some type of GSEC securities. We have to find out with your advisor, investment advisor. GSEC within 2 years, if it gives a return of say 6.4% or so YTM, that is yield to maturity. So if it gives around 6.4, 6.5%, which is say 1.5 to 2 years period, if it is there, I think this can be considered. Then we have got, of course, there are certain bonds being floated by power finance corporations, but you have to be very careful about this. You have to look at the rating and look at whether it is guaranteed by the respective state governments. Those are offering some higher returns, 8% plus. We got UP Power Finance Corporation, Andhra Pradesh Finance Corporation, and Tamil Nadu Power Finance Corporation. But we're not promoting anything, but you can just check your background about all those things, check about the credibility and the guarantees, the ratings and all those things. So to that extent, these are offering some decent returns for the time being, which you can probably do it for a shorter period of time. So that way the G6 of giving something like a YTM, which is much more than the FD by at least 1% or so, but not a longer period, because interest rates are bound to increase, and probably this 5.5% in the banks can come to 6.5% within a year or so. So in a shorter period of time of 1 year or so, you will see the FDs coming between 6.5 to 7.5%. So that's possible. So you can wait for a shorter, put for a shorter term, and then roll it over when you get a higher interest rate of at least 1.5% more, probably by in next 1 year time or so, where the interest rates will climb. So these are the areas where probably you can look at it. So we have clearly delineated some stocks, some sectors, and also we have talked about what happens in future if Nifty is going to fall and how you should strategize your position, whether gold is an alternate class for investment right now, and what are the other areas of investment. So this is what we wish to discuss with you in today's topic. Tomorrow we will look at the markets a little depth in chart, particularly Nifty, Bank Nifty, and look at some option strategies also. So if you have any questions today, please ask. Thank you. Okay, Tata, somebody has asked, please tell us Tata Steel. Tata Steel, we have already talked about it, and Tata Steel is literally going down. At this point of time, I think any rise in Tata Steel has to be sold. It doesn't look good, both from fundamental as well as technical point of view. So thanks for your participation, and looking forward for your participation again tomorrow, where we will discuss option strategies and how we can do some rollover of option strategies also. Thank you very much. Good night.